Hello and welcome to another edition of the Friday Market Update. Lots of great data today. You're going to want to stay tuned. I think you're going to really enjoy this one. So I'm going to nerd out a little bit, but think it's important for you to understand what is going on. So buckle your seatbelts. Interest rates dropped down to 6.4% on a conventional loan and are now almost 6% for an FHA loan and VA loan. So what does this mean? If we go back just to April 30th, 3 months ago, rates were right around 7.52%, according to Mortgage News Daily. In a 3-month period, interest rates have dropped by over 1% and now stand at that 6.4%. So simply put, this translates to a $337 a month savings for a home buyer right now on a $450,000 loan. It has increased the buying power for an individual by over $50,000. So instead of a buyer having to look at a $400,000 home and they want to go a little bit higher, they may now have the opportunity to look at a $450,000 home. So hopefully values don't start going crazy again, but I'm sure when this hits the airwaves, there will be a lot of interested buyers, and I think we're going to get more activity in the marketplace. So the good news is that at least we do have a little bit more home inventory in Las Vegas, and there are homes available for now. So why the drop in interest rates? We've talked about two factors that have been driving interest rates: inflation and jobs. Today was the release of the BLS, Bureau of Labor Statistics Jobs Report. The BLS report has been highly scrutinized with the unreliability of data compared to its counterpart, ADP, which comes from the private sector. Today, the BLS job numbers came in at 114,000 new jobs, which is well below the expectations that they had of 185,000. The unemployment rate also jumped from 4.1% to 4.3%. This is above the Fed's target that they thought it would never go over 4.2%. So there is now some chatter that we could actually be in a recession. So inflation also continues to moderate, and there is no indication of anything that will derail the decline. The Fed's desired inflation is 2%. The Fed primarily looks at two things: PCE, the personal consumption expenditure, as their primary inflation index, which currently stands at 2.5%. CPI, consumer price index, is their secondary measure, which is at 3%. So their target, again, is 2%. These indexes are weighted very heavily by estimated rents within those indexes, and it's been skewed quite a bit over the last few months. So it hasn't fully been reflective of what the current market conditions are and rents coming down. So another inflation measure that's out there is called Trueflation. I don't know if they'll ever go to this, but it's pretty interesting. So Trueflation looks at 18 million data points compared to the roughly 80,000 data points in CPI and PCE. So guess what Trueflation index shows? Inflation is at 1.5%, which is below the 2% Fed target. So I think we're in really good shape on the inflation standpoint. So in addition to all the data that came out this week, it also was the Fed meeting where all the Fed governors get together, they talk in a room, and they decide on the direction of the Fed funds rate. So the Fed decided to keep the Fed funds rate the same, but indicated they were very close to starting to reduce the Fed funds rate, particularly in the upcoming September 17, 18 meeting. So the new question right now is not will they reduce it, which is almost a complete certainty, but how much? Will they go 0.25% lower or 0.5% lower? Our odds are actually now favoring a 0.5% reduction in the Fed funds rate in the September meeting. So remember, mortgage rates are market driven. Wall Street looks at the data available and then it buys and sells mortgage-backed securities. So the Fed's funds rate is set by the government. That is fixed. They set it, and this is what it is. And it's basically to use to slow down or speed up the economy. Wall Street is clearly seeing lower rates And that is why we have seen a substantial drop in mortgage rates this past week and over the last actually probably about 2 weeks. So to add some fuel to actually help mortgage rates even more is what is known as servicing value. So when mortgages are traded, Wall Street buyer wants to know how long will they likely have that investment? Will it sell off? Will it go off? And when mortgage rates are high, there is a strong likelihood that a homeowner may not stay in that loan for a long time because they'll refinance when rates drop, which is probably going to happen right now. So the mortgage is not as valuable long term as it will be refinanced into a new mortgage. So with rates dropping, there will be less probability the loan will be refinanced again. So the value of the mortgage is actually now higher. So when rates drop, the value of the mortgage goes up. So we will likely start to see higher servicing values, which will also help lower mortgage rates. So it's good all the way around. So, okay, thanks for staying with me for the entire time. That was a lot of technical stuff. I felt it was important to give you a broad perspective. We're never out of the woods. It's something that can always happen in the world to derail us. But for now, enjoy the lower rates. Let your clients know and have them get out there and do it. So getting your buyer educated on buying a home now can truly benefit them long term. And it's difficult for buyers to understand the financial numbers unless they see them in front of them and they understand them. So as always, feel free to reach out to me directly to get your buyers pre-approved and educated so that they can make the right decision for them. You can also send them to my calendar link, which is here below, where I will go through a free CIA analysis, credit income asset analysis, so they know where they stand now and what they need to do to get into the home that they want. So let's run their numbers. Hope you have an awesome weekend. Yay for the rates, and we'll see you next week. Gaylord out. Bye-bye.